All right. Hello. Good evening, everyone. Those of you who are joining live, so glad you are here. Those of you who are watching the recording, thanks so much for your interest and spending some time with us. We're really excited for tonight's presentation on financial planning for long-term care with Robert Bandura. My name is Eva Ting, and I'm the founder of Here to Honor. Our mission at Here to Honor is to cultivate community around end-of-life learning. And we do this through developing curriculum, hosting in-person and virtual workshops and events, and strengthening support networks among peers and professionals. So a few quick housekeeping items. Please do keep your mics muted while Robert is presenting, but feel free to keep your camera on or off. And we will open up for questions and conversation with Robert later, at which point you can unmute your mic to ask any questions you have. If you don't want to forget anything during the presentation, you can also type things in the chat box and we'll make sure to include them in the conversation at the end. And this presentation is being recorded and you will have access to it for 30 days after tonight. So I'm going to introduce Robert very briefly. He also goes by Bobby. So you'll hear me calling him Bobby. And then we'll hand over the time to him because I know he's got a lot of great stuff that he wants to get through. So Robert Bandura is a wealth management advisor with the TFS Wealth Management Team. His passion is to help new as well as established families and businesses plan for their future goals, then implement strategies to ensure they are successful no matter what life brings them. This is accomplished with the help of his team of professionals and consistently monitoring, refining, and revising his clients' plans when needed. Robert graduated from Towson University in 2013 and is a proud husband to his wife, Katie, and father to their daughter, Reagan, and son, Will. So thanks so much, Bobby, for being here. The Zoom floor is yours.
Okay, great. Thank you. Thank you so much, Eva. I really appreciate it. I'm just going to share my screen. Oh, wrong button here. Okay. So thank you again for all that are here in person live. And for those of you that are watching the recording, I do appreciate it. Just got to get one more thing going here. What's going on here? Okay, great. All right. So as Eva said, my name is Bobby Bandura. We're going to be talking specifically about long-term care planning today. I'm glad you could join us. Eva went over. I'm a wealth management advisor. I like to consider myself a comprehensive financial planner. In other words, it just means that when I create a financial plan for an individual or family, I look at their entire financial picture to create a plan that will help them achieve their financial goals. So before we start the main part of our presentation, let me take just a minute or two to tell you what we hope to accomplish over the next 30 minutes or so. If I talk a little quick, I do apologize. I have a lot of important information I want to get into. I will make sure that there's time for questions. If there's anything you have any additional questions about, or maybe it's a personal question you don't want to talk about over a recorded Zoom webinar, not a big deal. I'm always happy to set up a consultation. There's never any obligations or consultation fees. I don't believe in that. So just keep that in mind that if you miss something, there's going to be a recording. And if there's a question you want to ask later, I'm around. I'll be happy to chat with anyone that wants to reach out. Okay. So our commitment at TFS, it extends beyond what I would consider just simply offering financial services. We are committed to helping you evaluate your financial situation and giving you the tools to help you make informed decisions and pursue your financial goals. So I'm hoping, as I said, after this webinar, you'll feel comfortable reaching out to me to set up a complimentary consultation, as I mentioned. So let's get into it here. We're not in person. I'm not going to ask anyone to raise their hands, but a rhetorical question here: how many people attending this webinar or watching right now have aging family members or someone in their lives who might need long-term care, or perhaps already is receiving care? I'm assuming it's everyone. Either you know someone that has it or is in need of it. Okay. It's hard to face the fact that our own physical or mental health might decline with age, or that our parents may need support, but statistics suggest that the odds of needing long term care are quite high, especially when we reach this magical age of 65. Okay. 70% chance of needing some type of long term care when you reach the age of 65 at least once in your lifetime. 70% chance. If you're over the age of 65, there's a 20% chance you will not only need long term care, but you'll need it for actually over 5 full years. Smaller percentage here, but there are 8% of people that are between the ages of 40 and 50 that have a disability that also requires long-term care services. Okay. So what is long-term care? Long-term care refers to the ongoing services and support that you might need if you become physically or mentally disabled due to a prolonged injury, illness, or cognitive impairment, such as Alzheimer's disease is a big one that people know of and are aware. A lot of people might have heard of a family friend or a coworker, or their own relative that is dealing with something like Alzheimer's, for example, and that's on the broad spectrum, I would say, of perhaps worst case scenario of level of care needed. Okay. So when we talk about the level of cares, there's three distinct levels of care that we can look at through a variety of different settings. Okay. So number one, skilled care. That's going to generally refer to round the clock care that is provided by professional healthcare providers such as nurses, therapists, and aides under a doctor's supervision. Next, we have intermediate care. That's still going to be nursing and supportive care, also provided by professional healthcare providers, but it's not on a 24/7 type of basis. It's less frequent skilled care. And then lastly, the most common, we have custodial, or also known as personal care. It describes the personal care often provided by family caregivers, nurses, aides, and home health workers who aid with one or more activities of daily living, such as bathing or feeding, for example. So, where can you receive care for long term care needs? Okay, quite a few different areas. And if you're like most people, you probably want to stay in your own home if possible. When you receive care in your home, family caregivers, friends, or trained homemakers may be available to provide the bulk of assistance with everyday tasks, as well as professionals such as nurses, therapists, and home health aides. They can also provide occasional home health care as well. Another long-term care option is assisted living. If you visited an assisted living facility, then you know it's a home-like facility that combines housing, personal assistance, and limited health care. So this option may be preferable if you cannot continue living alone, but you want to remain independent at the same time. An adult daycare facility, that's a community-based center that provides healthcare and social services for the people who can't be left alone. And these facilities especially benefit family caregivers by providing a few hours of much needed relief from care during work hours or perhaps in the weekend. A nursing home generally offers all three levels of care: skilled care, intermediate care, and personal care. Most nursing home residents have a disabling illness or cognitive disorder, as I mentioned earlier, such as Alzheimer's disease, that perhaps is just so serious that care cannot be adequately provided anywhere else. So there's a lot of common misconceptions when it comes to long-term care. Um, and despite people's concerns of aging, many people don't take action to address high risk of long-term care needs because of these four main misconceptions. Okay. Number one, I'll never need long-term care. It's just simply not true. I already went over 70% of people over the age of 65 will end up needing long-term care coverage, or I should say care at some point. Number two, it won't be that expensive. We'll discuss the national costs of care in different settings in just a little bit. Okay. Number three, some mistakenly assume that Medicare or Medicaid or other health insurance will cover the cost. and we'll address Medicare and Medicaid later as well. And lastly, some people may hope that if long-term care is needed, their spouse or other family members will take care of them. Okay. So let's start there. The last point I just went over. If your preference is to rely on family, keep in mind that caring for a loved one with a disabling condition or a cognitive disorder, it often changes the lives of the caregivers and their families. There can be lasting effects such as financial pressures, legal issues, health problems, and emotional turmoil. Okay. About 41 million people provide unpaid care for family members in the US, and many provide care for someone with cognitive issues. Okay. 61% of caregivers are women, and 34% of family caregivers are ages 65 or older. So a lot of times it's actually essentially the perhaps an elder person caring for another elder individual. Unpaid caregivers provide an average of 34.7 hours per week on caregiving in addition to their own jobs. So try to imagine working a normal 40-hour week, and then morning, evening, weekends, you have roughly another 40 hours to care for someone as well. So 4 in 10 caregivers, as you can imagine, consider this situation to be highly stressful. I'd like to think it's maybe a little higher, and some people are just thinking of their own family members and they don't want to admit it. But these are the commonalities of what's going on with personal home care. Okay. So you're probably here today because you understand the importance of developing a long-term care strategy. Doing so can certainly help protect your assets from potentially devastating costs. It helps you maintain your independence. You can preserve the freedom to choose where you'll receive your care, and also avoid becoming a burden to your family if you should need the support, as we just went over. Okay. So today's focus, 3 main things we're going to go over and discuss. And the first of those 3, we're going to first look at the potential cost of care in different settings. Okay. So cost of care, these numbers are as of 2021. I will be getting updated numbers, but it's important. It's good that I'm showing a couple of years ago, because it's important for everyone to understand that healthcare costs, they inflate higher than the national inflation rate, almost always. Okay. So the numbers I'm showing here may seem high. Unfortunately, they're already higher. Now that it's 2024, it's only going to get higher. Okay. So how expensive is long-term care? As you can see here, the cost can be substantial, and facility costs specifically have been rising rapidly, as I just alluded to. Every year, many Americans unfortunately become impoverished by the need to pay for nursing home care, but with proper planning, you may be able to avoid this happening to you. So just going to point out a couple things here, looking at annual numbers just to make it a little simpler instead of monthly. Homemaker services, okay, close to $60,000. Same with home health aid, okay. But now, if you needed some form of assisted living or perhaps even nursing care, you're going to see the median average of the U.S. Now it's going to start jumping up real quick in annual costs. Semi-private room, not even a fully private room in a nursing home, $95,000 roughly. It's closer to 6 figures now for sure. Private room in a nursing home, that's well over 6 figures already. And please remember, that's the median cost throughout the US. Depending on where you are, me being in New Jersey, Eva being in New York, it's going to be more. And I'll get into that as well. So let's consider the type of long-term care that's likely to cost the most. As I mentioned, nursing home care. And as we just noted, the national median cost for a semi-private room in a nursing home is roughly $95,000 as of 2021. For our purposes, let's just consider what the cost might look like in the future. All right. Someone that right now is healthy might perhaps not concerned about long-term care coverage or long-term care itself. But that's the problem. Unfortunately, a lot of people only worry about it when it's actually needed. So if nursing home costs were to continue to rise every year at a 4% average rate, the cost 20 years later, from 2021 to 2041, that cost is now $210,000 a year, roughly. Once again, that's the median average, not just saying that's not New York, that's not Jersey, that's the median average. Okay, so it's easy to see how the high cost of long-term care can threaten or even wipe out your retirement savings and jeopardize any assets you may want to leave to your loved ones. Okay, now let's get into actually where you live. All right, we got 5 different locations in the US. This is now a private room, assisted living, and a private, semi-private room in nursing home care. Okay, so I'm going to focus on the last one here, New York. I'm in New Jersey. Eva's in New York. I assume a lot of you are also in the tri-state area looking at this currently. We're at 55,000 in the assisted living facility. All right, we're at over $150,000 already for semi-private room care in a nursing home. Okay, so it's already quite up there in price, unfortunately, and it's not something that's going to just go down due to what's occurring in the economy. It's just unfortunately it's not. It's only going to continue going up. Okay. So if you haven't already done so, I do urge you to visit some of the senior living facilities and nursing homes in your community so you can get an idea of what long-term care services will be available to you and or your family members. Okay. You can learn more about facilities in your area by asking people you trust. Another way to connect with providers and services is to visit this link here, medicare.gov/nursing home compare, or you can also go to eldercare.acl.gov, which is a public service of the U.S. Administration on Aging. It's real important to compare the costs and quality of the facilities you're considering. And definitely, as I said, visit them even more than once if possible. Ask questions, talk with residents and their families. The more information you have, the better. Consider it like you're about to buy a home. I remember when I bought my home, my realtor said, let's go talk to the neighbors, get to know the area, hear what they have to say about the community. You have an inspector look at your home and look at every nook and cranny. You want to do the same when planning for any sort of long-term care facility if it ever becomes a need. Okay. So now that we have a better understanding of where you can receive care and the potential costs, let's discuss methods to pay for long-term care. Okay. So there's several ways to pay for long-term care. Naturally, number one being just paying out of pocket using your personal resources, such as your income, savings, investments, and assets, such as your home, even. We could rely on government programs such as Medicare and Medicaid. I will get into that. It's not typically or not always an option for people. So we'll get into that. Or there is the ability to purchase actual long-term care insurance coverage. Just like you would buy insurance on your car, you can actually buy insurance for long-term care needs. A newer, more modern version of this, instead of just buying a long-term care insurance policy, is this last option. It's adding a long-term care rider to a life insurance or annuity product. It's basically creating a hybrid insurance policy that accomplishes perhaps two things at once, which we'll get into at the end of the presentation. So, all right, first payment option. We're going to look at self-funding or paying out of pocket. This means using your income, savings, investments, your assets, such as your home, to pay for that long-term care. And I like to call this the default option because most people don't really decide they're going to pay expenses themselves. It simply happens that way because they just haven't put together a long-term care plan. They're not thinking ahead. It becomes a need, it becomes an issue, and now they're kind of forced into that option one of paying out of pocket. Okay. There is an advantage or two, right? The major advantage of paying out of pocket for long-term care is you have better control over where and how you receive care. It's totally up to you. For instance, you can hire anyone you want to help with the care. Obviously, this flexibility is ideal if you can afford to pay for your own care, but counting on being able to self-fund is truly a gamble unless you're quite wealthy because you're betting that you will be able to afford to pay for the care you'll need, often using the money you've saved for retirement. What if your gamble doesn't pay off and you deplete your life savings? Will you be willing to sell assets you hope to leave to your loved ones or perhaps a charity to raise the cash you need? That's something that unfortunately becomes a circumstance for many people that think they can cover the cost out of pocket. And keep in mind too, that once your money is gone, you have very few options again. You may have to rely on your family members for care. And if that wasn't something you were hoping to do or don't have a family member for care, you might have to try to qualify for Medicaid to pay for that care. Okay. Another option, you can use a reverse mortgage. You've probably seen or heard well-known actors on TV or radio talking about the advantages of a reverse mortgage. I know I personally see one with Tom Selleck all the time. A reverse mortgage, also known as a home equity conversion loan, it'll allow homeowners age 62 and older to borrow against the equity in their home and use the proceeds to hire caregivers or make home modifications that allow them to remain in their home. A reverse mortgage is different from other types of mortgages or equity loans because there are no mortgage payments to make. Truly, what it really is it makes the mortgage payments optional. So you have the option to pay back the mortgage, or you can choose not to. But if you don't, there is going to be interest like any other mortgage. And that interest will continue to grow your mortgage balance if you choose not to pay it back. But there is the benefit of a reverse mortgage where they can pay you money through the equity that's in your home. Okay. The drawbacks, though, on reverse mortgages, it may not be suitable if you'll remain in the home for only a short time. There's going to be closing costs. It's really not worth the fees if you're only going to then leave the house due to health concerns. The loan must be repaid when you move out, sell your home, or pass away. So one way or another, the mortgage will be paid off. Amount that can be borrowed, it's typically much less than the actual value of the home. And unfortunately, with the interest rates where they are currently, you're just not able to get as much as you probably would like out of a reverse mortgage. As I mentioned, this is also going to involve some substantial fees. There's origination fees, closing costs, and servicing fees over the life of the mortgage. And if you don't pay the mortgage, which is an option, the interest will keep adding to the balance. Okay. So let's talk about relying on government programs. All right. Let's start with these two true or false statements. All right. Think to yourselves for the answer. Who believes that Medicare will cover all your healthcare expenses in retirement? Okay. The answer is false. It's not the case. Okay. Next, who believes that Medicaid will cover your nursing home costs? I'll get into it, but typically it's not a case for most, and for those that can, it's not all. Okay, so let's start with Medicare. I'd like to clear up some misconceptions you may have about Medicare and when it comes to long-term care. So for those who qualify, Medicare will only pay for the cost of skilled nursing services, physical therapy, and occupational therapy under specific conditions and for a relatively short period of time. Okay. This chart shows what Medicare covers depending on the duration of care. Long-term care is not typically a short duration. So, yes, first 20 days of care is fully covered by Medicare. Fully paid, patient pays nothing. Okay. From days 21 to 100, now they're going to reduce to only partial coverage, and you will have a $200 payment per day. All right. So if you do the math there, that's 80 days, 21 to 100, 80 days, 200 a day, that's $16,000 that is now out of pocket. Okay. And that's with them partially covering whatever it may be. Anything over 100 days, if you have a long term care need, Medicare is not covering whatsoever. All right. Medicare is meant for your inpatient and outpatient needs. There's also Medicare D for drug prescriptions. It is not meant or intended for long term care needs. It's very little that they will cover, as you can see here. Okay. Now let's talk about Medicaid. Okay. Because their names sound alike, unfortunately, Medicaid is often confused with Medicare. Medicaid is the joint federal state program that many nursing home residents rely on to pay some of their long term care expenses. And as this chart shows, Medicaid is the largest public payer of long term care services in the country. But here's the catch. Okay. To qualify for Medicaid, you have to either be quite poor or you have to basically become quite poor. You have to basically make yourself poor. Okay. You'll have to use up most of your savings before you even qualify for Medicaid. And aside from a small personal needs allowance, you will have to use all of your retirement income including Social Security and pension payments, to pay for your care before Medicaid pays anything. Once you qualify for Medicaid, you basically will have little to no choice regarding where you receive care. Only facilities with Medicaid approved beds can accept you. All right. So now you're kind of restricting where you can even get the care. And to get on Medicaid, you basically have to get rid of all of your assets. Okay. Applicants in some states who meet Medicaid eligibility requirements, they may be able to apply for a specific program that allows them to self-direct their own care. But I would just say, if you're really interested to learn more, contact your state Medicaid office about its programs and its eligibility requirements. And you can find that at medicaidplanningassistance.org/state dash specific dash Medicaid eligibility. In a real quick moment, I'll pause there if anyone really wants to write that down. But don't worry, it is being recorded if you don't want to write it down. Okay. So, how impoverished do you essentially have to be to qualify for Medicaid? All right. So, because each state establishes its own limits under federal guidelines, eligibility rules do vary, but all states do count income and assets when deciding who qualifies for Medicaid. In most states, your monthly income can't exceed a certain limit. Often, the rate Medicaid would pay the nursing home for your care, although you may be allowed to spend down your income to this level by essentially paying for part of the cost of your care. So some of the states will allow you to kind of cover some of the cost out of pocket and let Medicare cover what it can otherwise. But in other states, an income cap applies completely. If you apply for Medicaid in one of these states, you won't qualify for Medicaid if your monthly gross income is more than 300% of the supplemental security income, the SSI. This is a strict income limit. You cannot spend down your income to qualify for Medicaid in these states. Okay. In most states, a single applicant won't qualify if he or she has more than $2,000 in assets. And when I say assets, that generally is going to mean anything that has a cash value. So that's savings, your investments, real estate, for example, as well. If you're married, your spouse will be allowed to keep a little more. So, you know, you are allowed to, you're permitted to have one home for your spouse to live in, technically still, if and get on Medicaid for yourself. But some assets are not counted actually towards Medicaid. These assets include your house. As I said, while the spouse is living there, it won't count. You're permitted to have one car, your household belongings, personal belongings. That's not going to go towards your assets. A small amount of life insurance is permitted, as well as a Medicaid compliant annuity. Also, if you have burial plots or prepaid funeral expenses, that won't count towards your assets. But an important thing to remember is just because an asset is not considered or not counted by the state when determining whether you qualify for Medicaid, it doesn't mean it will never be touched. Okay. The laws in your state may allow a lien to be placed on your home or other assets at the time you qualify for Medicaid, so that after you and your spouse die, the state can recover part of what it has paid out in Medicaid benefits. All right. So, what is Medicaid planning? Okay. So, to help ensure that you will be able to qualify for Medicaid without undue delay, should you ever need care, you may want to plan ahead by distributing or protecting your assets. That's planning ahead, right? This is once again an option you have to cover the costs. You may be able to use assets that normally count toward Medicare eligibility, such as your personal savings, to purchase a limited amount of assets that are not counted, such as a small term life insurance policy, as I mentioned. You can gift the money away to family and friends as well. Another option that may be available in your state is to put your assets into an irrevocable trust. Okay, that's done with a estate attorney. Basically putting the money in the trust can protect the government from seeing what assets you have. But under federal law, when you apply for benefits and are receiving nursing home care, Medicaid has the right to look back at your finances for the previous 60 months, 5 years, right? So if you've transferred assets, even it's into the trust or you've gifted it to someone, if you've transferred assets within that look back period for less than the fair market value, even if you had no idea at the time that you would need long-term care, you will be ineligible for Medicaid until a certain amount of time has elapsed. And there's this whole equation involved depending on the level of care, the average level of care in your area based off of what you've essentially given up. Okay. So, uh, last thing we're going to look at as a way to cover long-term potential long-term care needs is purchasing long-term care insurance or similar types of coverage. Okay, so long-term care insurance itself, what it is essentially a private insurance that pays benefits if you need the extended care. So, like other types of insurance, long-term care insurance protects you against a specific financial risk. So in this case, the chance that long-term care will wipe out your life savings is the risk we're looking to avoid, right? While paying out of pocket may be ideal if you're very wealthy, and maybe relying on Medicaid is going to be a good option if you're already perhaps in a very low income bracket and you're on the poor side already, and you can qualify right away. Long-term care insurance and alternative strategies to long-term care insurance, um, that's going to be especially valuable for middle-income Americans who want to preserve their financial independence and quality of life. Regardless of your income level, long-term care insurance gives you the freedom to choose where you receive care. So if you need nursing home care, you'll have a wider choice of facilities than you would if Medicaid was paying for your care. With insurance covering most of the bill, your retirement savings won't be depleted on long-term care costs. And if you must enter a nursing home, it'll enable your spouse to maintain a comfortable standard of living, and you won't need to spend down your assets in order to become eligible for Medicaid. So how does it work? In order to buy a long-term care policy, essentially you must be in reasonably good health. Like a life insurance policy, they are going to ask you health questions. They're going to want to know if you have any health problems. They're going to want to do perhaps even some form of a physical, depending on the carrier. And once you develop health problems, that may result in the need of long-term care. You're going to have a lot of trouble qualifying for any type of policy. Okay, so the premium you pay for the long-term care policy, just like life insurance, it's going to be based on your age at the time you purchase the policy, as well as the features and benefits you choose. So, in exchange for your premium payments, you receive a promise from the insurance company that if you ever need extended care, the insurance company, not you, will foot most of the bill, right? To receive the benefits, you generally must be chronically ill or cognitively impaired. And more specifically, you basically just need to prove from a doctor that you need help with at least two of the six activities of daily living. And these activities are going to be bathing. Bathing yourself, being able to wash yourself, continence, being able to keep it in if you have to go to the bathroom, dressing. Can you get dressed on your own? Transferring. Can you move? Are you mobile on your own? Feeding, can you eat without anyone helping? And toileting, can you actually use the restroom all on your own? Okay, two of the six are something you can't do anymore. The doctor can show that with a doctor's note and proof. Then that's when your long-term care coverage would kick in and you have the protection. Before you receive any insurance benefits, I should say that you will need to satisfy a waiting period. A lot of times they'll call this an elimination period. So during this time, you'll have to pay for long-term care expenses yourself. So you should be prepared to pay for part of your long-term care costs, even if you decide to buy some form of long-term care insurance. You should be prepared to cover some of it because remember, Medicare is only going to cover the first 20 days completely. After that, it'll subsidize it a little bit. And then depending on the policy and different bells and whistles you put on that policy, will decide and it'll basically choose when your coverage will begin. Okay. Very common elimination period is like 60 days, maybe 90. Those are very common elimination periods. So once you begin receiving benefits, though, they will continue to be paid for as long as you need the care or until the policy limits are reached. Okay. So once you decide to buy long-term care insurance, or when you're thinking of it, you really got to look at a few different very important factors, and you're going to want a policy that provides perhaps the broadest coverage at a price you can afford, I should say. um, Policies vary widely. It's very important to make sure any policies you're comparing are alike. They got to be an apples to apples comparison, because there's so many different little caveats in a long-term care insurance policy, that you want to make sure you understand what you're comparing if you're looking at two different quotes. Okay. And although I can't cover everything in this webinar, there are five key features, as I mentioned, to consider when applying, or that I should say, that'll affect the premium you pay when applying for long-term care coverage. So first, you'll need to choose the benefit amount that will be payable should you need the care. So what we call the daily benefit amount, that's the maximum amount your policy will pay each day. And it generally ranges from $50 all the way up to $350 a day. That's pretty common. Number two, you'll also need to choose a benefit period, which is, as I mentioned earlier, the length of time your policy will pay long-term care benefits once you need the care. Most benefit periods range from 1 to 6 years, with some policies actually offering a lifetime benefit. That is something that is very, in my opinion, rare these days. It's not as common anymore. And when it is available, it's very costly to have a lifetime benefit. You may want to choose a benefit, though, a benefit period that coordinates with that 5-year look back period I mentioned earlier. So perhaps you have coverage for 5 years. Perhaps you just put all of your assets in a trust, or you gifted it away, whatever it may be. And now you're not, well, in this situation, maybe the money's in a trust, right? So you have your assets still. You didn't just spend it all to essentially get approved for Medicaid. And now you're able to essentially have the coverage needed to cover all or most of the long-term care needs, the long-term care cost, I should say. And then after that 5th year, where all of a sudden your coverage is gone, the 5-year look period is gone, and now you could perhaps apply for Medicaid. Okay. So number three, in addition, every long-term care policy allows you to choose an elimination period, as I mentioned earlier. So you got to figure out what is the number of days you'll pay for your own care before benefits kick in. Obviously, the less elimination period, the smaller the period, the a little bit pricier the policy will become. Number four, where you may want to receive care in the future is another important consideration, right? Although you can purchase bare bones policies that only really cover nursing home costs, many policies do cover care in a variety of settings. That includes the four I mentioned at the beginning of this webinar: your own home, an assisted living facility, an adult daycare center, and even a nursing home. Okay. And lastly, you're also going to need to decide whether you want inflation protection. And what I mean by that is, essentially, as we talked about, they're going to keep increasing healthcare costs, including long-term care and nursing home expenses. Okay. So what a lot of these policies offer, if you want to pay for it, is they'll actually include an inflation rider. And what that means is each year you have the policy, the coverage amount will actually inflate, and it'll compound by a specific percentage amount. Okay. So your benefit will increase by a certain percentage each year. Inflation protection is an optional feature that I mentioned. It'll make it rise significantly, but this is so important in my opinion, because if you don't need the care for 20 years from now, just went over in the beginning of the seminar, you could be looking at over $200,000 for just 1 year of semi-private care in a facility. So having something that increases your coverage is very, very vital, in my opinion, if it's possible to pay for that inflation rider. Okay. And there's also some potential federal and state tax incentives when paying for long-term care insurance. It's not a guarantee, but you can deduct the premium you're paying into the insurance if you meet the requirements for the medical expense deduction when filing your taxes, which it just all depends on essentially how much you're paying for medical expenses in a given year. But keep that in mind as another potential benefit and that could help subsidize maybe some of the cost going into the long-term care insurance. Okay. So lastly, the other insurance options that are out there, in my opinion, this has become the most popular way to protect against a long-term care need other than Medicaid planning. So, if you're wary about paying for traditional long-term care insurance, because there is a chance you technically may never actually need long-term care, that money will not go towards a need, right? If you never get into a car accident, you never used your car insurance, but people still pay for their car insurance, right? So I still believe in long-term care insurance. I believe it's there for a reason, but if you're wary about paying for it with no actual benefit, if you never need the long-term care, there are ways to essentially link a benefit or add on a rider that's designed to aid in the reimbursement if long-term care expenses are ever needed, and that's done through different life insurance policies as well as different type of annuity products. Okay, so life insurance products that I'm referring to, a lot of times we'll call them hybrid policies. These hybrid life insurance products, they combine a long-term care benefit as well as the traditional death benefit that you see in a life insurance policy. So if God forbid you do need long-term care, there is going to be money available from the policy. Sometimes it's essentially just the death benefit being given out while you're still living. Other times there are actual separate benefits and multipliers, as I mentioned earlier, from traditional long-term care insurance. And the nice thing is, if the money is never needed for long-term care, it's a death benefit. It's going somewhere. Someone you love, or perhaps a charity you care about, is going to receive that money, and it's not going to waste. If you need the care, but perhaps it wasn't for too long, if there's still a balance, that will still go to the beneficiaries you have listed on that policy. So this is not a term policy. This is not a 20-year term policy. This is a permanent life insurance policy that you'd be paying for this type of coverage. Okay, so some of the positives: premium is guaranteed. It's not going to increase ever. Um, you may be maybe a little easier to qualify for this type of coverage over traditional long-term care insurance policies. And it might even actually allow for your family member to care for you. If, let's say, you just needed some home care, you can actually pay a family member through the benefit that's provided in these life insurance hybrid policies. So they'll pay you the money, and you can pay out a family member. So it's not really going to waste whatsoever. Some negatives: you're not going to get as much coverage as just a traditional long-term care policy. It may not include that inflation protection option I mentioned. It could, just depending on the type of policy you're looking at. And with this type of policy, you're not going to be eligible for state Medicaid partnership programs. Once again, if this is used up, then you certainly could be. It's just this would have to be used first before anything else. So that's one of the more common options used these days. The other option, which is actually even easier to get approved, if maybe you're not in the best of health, it's even easier to get approved for an annuity product or an annuity policy that has some type of a long-term care rider attached to it. Okay, so a deferred long-term care annuity, generally it's paid with a single upfront premium payment to the insurance company, who will then provide the future income if ever needed in the future. Okay, it's often a fixed annuity that offers enhanced benefits or enhanced payments for long-term care expenses. So these payments are usually based on a multiple of the annuity's cash value. So, real quick example: if my client has $100,000, I'm using whole numbers, and it's not earmarked for retirement income needs, if they don't have any long-term care plan in place yet, and they do see the benefit to it, this is a situation where you can put $100,000 into a fixed annuity that has a long-term care rider attached to it. And if the long-term care is never needed, just like life insurance policy, the money will go to your beneficiary, because all annuities have a beneficiary attached to them, like a life insurance policy. They may offer a little bit more than what's put in because it is an annuity. The money is technically being invested within the annuity product. It's not going to be, a lot. It's going to be less than a life insurance policy probably. But what they do offer a lot of times is a multiplier. And what I mean by that is if you put that $100,000 into one of these fixed annuity products and you need the long-term care coverage, let's say that $100,000 was put in, they'll multiply it by maybe 3 or 4 times what was put in. So all of a sudden you go from $100,000 out of your pocket that could go as a death benefit to someone if it's never needed. So it's not being wasted. If it is needed, now all of a sudden you may have $300,000, $400,000 available to you in long-term care coverage. So it's a great other way to cover a portion or maybe all of your long-term care needs if it's ever needed in the future, while also giving you the ability to not miss out on putting that money towards nothing, right? The money will go towards someone if it's not yourself, uh, just like the life insurance. So um, the long-term care portion of the annuity premium, it actually may qualify for a tax deduction as well. And as with long-term care insurance products, you must meet certain health criteria, as I mentioned, but it is a lot less stringent than the other two options out there for sure. As I mentioned, any remaining annuity value not used, that's going to be passed on to heirs or a charity, whoever you want it to go to. And the annuity contract will certainly outline the amount that can be accessed each month for long-term care and the amount that can be accessed each year from the cash fund. Okay. You should be aware that deferred annuities are counted as assets for Medicaid eligibility. Okay. So that's important to know as well. So, as this webinar is drawing to a close, let's see how I did on time. Okay. Went a little long here, Eva. I apologize. I hope people are still with me here and have maybe some questions for me. But as the webinar does draw to a close, I do just want to quickly review a few of the reasons why you should begin planning for long-term care as soon as possible. Even though it's hard to face the fact that health problems may someday result in a loss of independence, we can't predict the future. Okay. I hate to say this, but are you willing to gamble that you'll stay healthy throughout retirement and never need long-term care? Unfortunately, the statistics show that majority of people will need some form of long-term care at least once, as long as they live to the age of 65, right? If you begin planning today, you'll have a lot more options open to you, including the opportunity to purchase long-term care insurance or some other version of coverage while you're still healthy. Okay. Another reason to begin planning now is to give yourself enough time to plan for Medicaid if that is the route you want to take. That's a strategy you want to go through with. Planning ahead could help you retain more control over where you receive care and may even allow you to qualify for that Medicaid a lot more quickly, less money out of pocket. And finally, by making decisions today about long-term care, and this is for me, this is what's personally what I think really is the most important. You can help relieve your family of the burden of having to make decisions for you. Okay. Keep in mind that when confronted with a crisis, people unfortunately they often make expedient decisions based on emotion, and that could lead to family conflicts, inadequate care options, a lot of stress for your family. It's essentially just taking a vital step toward preserving your independence and the financial well-being of your entire family, is how I'll put it. So um, you know it really does make sense to me to start looking at facilities even now, depending on, if you're 50 years old or older, I would start looking at facilities just to know what it could look like, get an idea of their services and cost. Then look at your finances. Think about what we've discussed. Do you have enough money to pay for long-term care out of pocket? If not, do you need more information about Medicaid planning? Or maybe you're interested in transferring the risk to an insurance company instead of your own life savings by purchasing some form of long-term care coverage. Getting an expert advice from someone like myself, perhaps to help with devising a strategy that will, help you meet your goals. That could be very beneficial, in my opinion. And as uncomfortable as it may be, I do recommend you raise the issue with your family. Talk to them about how willing they are to provide care when the time comes, or if that time comes. If you're even thinking of that as an option. And lastly, and this is something that I refer out to trusted attorneys that I work with, meet with an attorney, prepare healthcare directives such as power of attorney documents for healthcare, because this is a document that will outline your wishes for care and allow you to designate someone to make decisions in your behalf should you ever become incapacitated. It's an important yet sometimes overlooked way to retain some control over your own care, even if you face some serious health issues. So, I hope that I've given you guys some motivation to focus on long-term care planning now, not later. Having a well-planned strategy in place can prepare you for whatever comes next and can help you feel confident about the decisions you make. So, how can you put all this knowledge to work? The way I see it, the last thing I'll leave you with, there's three things you can do, three things you can proceed with. Okay. You can do it yourself. If you're a real do it yourselfer, you certainly can. Go for it if you want to try it. But I will say this type of coverage and this type of these strategies, it can get very confusing and convoluted as to what the best option is to take, I should say, and it becomes a tremendous amount of work. Okay. You could try working with others, whether that's working with me or someone else. If you want to have a chat, as I said, I'm always open to an absolutely free, no obligation consultation with anyone that's interested. I hope you feel comfortable with what we've learned about Medicaid planning, as well as these other options available to you to have a conversation with me. Or finally, you can procrastinate, which I know we all know is not what you should do, and it's certainly not a prudent move. So, in the end, the decision is yours. But I do thank you all for your time, and I do apologize for going long. This is just something I really do care a lot about, and although it's just a piece of the financial planning work that me and my team do, it's a very, very important piece that we always make sure to talk about with our clients. So I do thank you again for anyone that joined us live, especially, and anyone that's hearing this recording. I do appreciate your time tonight.
Thanks so much, Bobby. Really appreciate it. That was really informative.
Yeah.
We did want to open up for questions. If anybody has questions or want to follow up with anything that Bobby shared or needed further clarification, feel free to put it in the chat box, or if you want to unmute and ask the question yourself, feel free to do that. Anything come up for anyone?
And if anyone is thinking of a question, if not, no problem. This is something I like to give out. If I ever meet with anyone, it's in a case of emergency guidebook. I give these out once again, no charge. I get these myself for free from a wholesaler. I can call them up anytime, get a bunch. It's not a problem. I love these. Everyone should have some version of this. I don't care your age. I have one for my wife in case something happens to me. I have two kids now. God forbid something happens to me. It's a great thing to basically just list out, all of your assets. Do you take prescription drugs? It lists it all out here. What's your passwords for all of your online banking or any other personal, online accounts you have? It's just anything you can imagine. If God forbid something happened to you, what would you want your family members and loved ones to know? You can all fit it in something like this very easily. So if you ever want to chat, I'll happily send these out. If you don't want to chat with me and you want one of these, just let me know. I'll send it to you. Not a problem. So I
Thanks,
encourage people to
Bobby.
use something like this.
Thanks, appreciate that. We did have a question come through the chat box. Leslie asked, for someone
Yeah.
with annuities, can they be converted to a long-term care annuity?
Yeah. So it's going to depend on a few different factors. How long have you had the annuity, Leslie? Annuities are always going to have almost always they're going to have a surrender period, right? If you take the money out of the policy other than 10% annually, they let you take out 10% annually at no charge. If you take out more than that, if you surrender the annuity during the surrender period, it's going to cost you. I would never advise doing that unless there's a really weird circumstance. My compliance department wouldn't even approve it. They're going to be like, why are you doing this? It's costing the client money. So it depends on whether or not you're still within the surrender period, number one. If you can, if you still are in the surrender period, maybe it's towards the end and we can actually prove there's a better annuity for you for what you're looking to accomplish, then yeah, there's an option. But yeah, no, I mean, the short answer is you can convert an existing annuity to an annuity to another one. If it's a non-qualified annuity, yeah, sure. Yeah, not a problem, Jacqueline. To arrange a meeting, what I'll do is I'm just going to put my email in the chat, which I know Leslie Ava's going to put out as well. Um, but I'm just this is my email and this is my office number. I think 24. Yeah. Call either can't text the number, it's my office line, but call there, shoot me an email anytime, Jacqueline. But so Leslie, you can convert it. It just depends on how long you've had it. I'd want to basically run what we call an annuity audit. Once again, no charge, no obligation. I look at the policy you currently have. I have partners that we work with. We're an independent advisory firm. I'm a broker. I don't sell proprietary products. So I don't sell TFS annuities. All right. I broker them. I work with only A-rated or better carriers. So yeah, happy to schedule a chat with you, Leslie. Sounds good.
Yeah, I'll definitely send out Bobby's information. And I got to know Bobby because I set up a consultation with him, and I just really appreciated how straightforward he was and clear about different options, which is why we set up tonight's webinar, because I just found it so yeah, so informative and helpful to have the conversation with Bobby. So thanks for that question. Any other questions or items for clarification? I have one that
Yeah,
you kind of touched upon it when you were talking about the different products, but just kind of, if we were to look at like long-term care insurance, the hybrid life insurance with the rider,
right.
and deferred long-term care annuity, like what would you say kind of at a high level are some of the kind of pros or cons to kind of watch out for? Because they are three very different
So
products.
yeah, so the way I'd put it is you have long-term care in this hand, straight long-term care insurance. The benefit is it's going to get you the best long-term care coverage because that's what it's intended for, right? It's long-term care coverage. It's going to give you the best coverage. Okay. Negatives, it is costly. Unfortunately, a lot of carriers that used to offer long-term care coverage don't anymore, and that's just based off of back in the it was like in the 90s there were these actuarial scientists. Those are the ones that come up with the premium number. So they're basically mathematicians, these actuaries, and they basically undervalued how long people would end up needing long-term care coverage. So what happened was they devalued the cost and people were paying low premiums from long-term care insurance. And then all of a sudden it came time for them to actually need the care. And they needed the care a lot longer than these actuaries anticipated, and it almost put insurance certain companies out of business. It just they could their books were all messed up with how long they were fronting the bill. So now there's a lot less carriers that cover straight long-term care insurance, and they have upped the cost. So if someone can afford it, it's certainly still the best option, and they have to be comfortable knowing there is a chance that money will never be used if they're one of the minority people that never need long-term care. A lot of people these days don't like that. They don't feel comfortable just throwing money at something that maybe they'll never need. And a lot of people, through a comprehensive financial plan that we help build for them, essentially have a way where, all right, maybe they have to use a small portion of their own assets to cover, and then the hybrid policies will cover the rest. In most situations. And honestly, the best way to look at it, in my opinion, is as I mentioned, I have trusted attorneys. I refer to people getting a trust for your assets to be put in if you're in that position where it makes sense to do so, doing it as soon as possible now, 5 years and beyond from now, if that money's in that trust, the government doesn't see it. They can't touch it. All right. So once it's in there for 5 years, you don't want to just get on Medicaid because it's not the best coverage. You're going to be limited in where the facilities you can go to are. But after 5 years, if you have some sort of coverage, hopefully that covered the whole thing. But let's say it didn't, and now you used up your coverage. Well, at least now you can get on Medicaid while still not, being able to pass on to your loved ones or charity of your choice your assets because they're kept safe in that trust. Okay, my parents, very middle class. I grew up. I think a lot of you are from the New York area. I grew up outside New York in Rockland County, New York, just west of Westchester. I'm now in central New Jersey, but I still have clients all over, Rockland, Westchester, Manhattan. I'm everywhere. So I'm happy to meet anyone or do it like this again. But my parents are very middle class, but that's what they did. I'll just give you firsthand experience. They got a trust. They got life insurance back when it was long-term care insurance back when it was maybe a little more affordable. And my mother actually did get a policy that has lifetime coverage. So no matter how long she may end up in a facility, if that ever comes to be, she's covered. On top of that, though, just to be extra safe, and this is just my mother being neurotic, I didn't tell her to do this. She just did it. She also has a trust so that even if somehow, some way, something occurs where the care is no longer provided by the provider, let's say they somehow go out of business, who knows, right? She can get a Medicaid and not, you know, lose all the assets she's hoping to pass to my brother and I, which once again, we're middle class people. It's certainly not pennies, but it's nothing crazy. So that's a long-winded answer to your question, Eva.
Thank you. And then I think we have time for one more question, which is in the chat box. For someone you love who
Yeah,
already need long-term care without insurance, how do you stop the bleeding out of your assets?
yeah. If you're self-funding it currently, if you're self-funding, there's technically ways to get on Medicaid, even though there's that look back period. It may still involve, a lot of the assets eventually being taken away. But there is technically, once again, through estate attorneys, a lot of them, and the ones I work with, they also specialize in Medicaid planning. So there is technically ways to get hopefully on Medicaid. And then depending on how you're currently paying for it out of pocket, every now and then there's just a way we have found that maybe is a little more cost effective than what you're currently doing. And it's just based case by case. So always happy to chat with someone about it to talk more and figure out if there's a better way. But I'm not ever gonna just um, I'm never gonna just build a tall tale just to act like I can help. If there's not a way I can help someone, I'll be blunt and tell them that. So I'd have to have a conversation to learn more. But that's my off the cuff answer for you, Leslie. Is there's ways, but it's not always possible.
Great, thank you. Well, thank you again, Bobby. Really appreciate your time this evening and just sharing your insight and expertise with us. And thank you everyone for joining us. We will send out a follow-up email with a link to this recording and also Bobby's contact information if you do want to set up a time to chat with him. And we'll also send out information about other Here to Honor events that are coming up in the next couple of months. So thanks again for being here. Thanks, Bobby.
Yeah,
Stay
yeah.
safe,
Thanks.
stay
Thank you
warm.
so much, Eva.
Thank you. All right, take care, everyone. Have a great rest of your week. Thank you.
See you guys.
Thank you. Bye.